Okay, just one administrative note for everybody in the room. The online audience is joining us, and we're going to start the program in 30 or 45 seconds. As soon as everybody can get settled through the portal. Go ahead. Well, good afternoon, everyone. Thank you for being with us. Our audience today is here at the Competitive Enterprise Institute. My name is Kent Lassman. I'm the president here. I'm joined by Mark Calabria. It is also online, so welcome to our online participants. We'll be taking questions throughout the hour. In the room, there'll be a microphone available that'll be coming around to make sure that you're heard. And if you're online and you want to take part in the conversation with Mark, our author today, there's a Q&A function found at the bottom of your screen. You can type in your question there. It'll be fed to me here at the front of the room. Today, we're going to talk about Shelter from the Storm, Mark's new book about a very interesting time in America's financial history. This is the intersection of COVID, government lockdowns, and some shakiness in the mortgage and rental markets. I learned a lot reading the book. I look forward to the conversation, and I just want to get started with a big thank you, not only to you for the work that you put in to this book, documenting your time as a federal regulator at FHFA, but also to our friends at the Cato Institute who have made books available to us as the publisher, so those of us in the room can make sure to take one home.
You're welcome.
Mark, let's start with the biggest softball that I have. Who did you write for? What's this book all about? And why do we need to read it today?
Well, let me start with at the end of that. I think it's quite topical now that we're again in an environment with Signature Bank and Silicon Valley Bank, where there is stress in segments of our financial market. And again, there are calls for bailouts and delivery of bailouts. And what I wanted to do with the book, because again, in March 2020, we went through a very similar situation where there was stress in the financial markets because of the fears from COVID. So I wanted to give readers an inside sense of what it means to be a financial regulator sitting in that seat where pretty much 99 out of 100 calls you get are, we need you to rescue this now. And to kind of have a sense of what it's like to feel that pressure. And also for me to have made different decisions. So part of the conversation of the book is how certain calls for bailouts were resisted, and how we took a very data-driven approach. So I want this to walk away with, there are alternatives to bailouts. You can directly assist households and families, which is what we did in terms of housing, mortgage, rental distress from COVID. So again, I wanted to give perhaps an alternative narrative that you don't always have to put a fire hose on Main Street and on Wall Street in order to help Main Street, and have some sense of what the inside of that is. So certainly those are interested in financial regulation at large. It is, I believe, a very accessible book. It's what I would call a policy memoir. There are insights and anecdotes from COVID, from the crisis in the financial markets. There's explanations on what was going on in the housing market and the mortgage market. Again, I believe in a very accessible manner. So certainly a general audience, but also, again, a guideline that, were you to ever find yourself in a similar position in government, here are some things to kind of keep in mind, and a roadmap and some of the lessons I learned. And I thought it was important, having been part of those decisions, to explain why we made certain decisions. So I hope in some sense to create a precedent for other policymakers. We had a number of books after the financial crisis of 2008, where whether it's Secretary Paulson or Fed Chairman Bernanke, who wrote their side of the story. I think those are important contributions to history, even if I may not agree with every element of it. So I thought it was just important to get some of the record down for what the response was to the non-healthcare side of issues from COVID.
I want to situate us properly. It seems like a million years ago, 2020.
It does.
But you were relatively new into the job of what is also a relatively new regulatory agency. There's some startling numbers that you share right at the outset of the book. that we're talking about early 2020, 22 million jobs from February to April, 2.5 months, 22 million jobs taken off the table. And by comparison, the financial crisis that you just alluded to, some 10, 12 years prior, 9 million jobs had disappeared over the course of 2 years. What was it that helped you identify and even understand what was happening with respect to housing versus mortgages versus rental? How did you understand where to direct your attention?
Great question. And it's important to keep in mind, we have never, and hopefully never will again, see that level of job contraction so quickly as we did in early 2020. And of course, as we know repeatedly in past recessions, when someone loses their job, they often have trouble paying their mortgage and paying rent. So we knew that right away. We also know that the unemployment insurance system takes months to get there. You may have to wait 3 or 4 months. And for many, you may not be able to cover your housing expenses during that time. So we quickly knew there was going to be a crisis. We were doing pretty good data analysis in March 2020. And one of the things that hit us right away is that this was going to be predominantly a renter crisis. Only about 40% of those who lost their jobs during COVID had a mortgage. So we had to give those families a timeout. And again, it was a timeout. You know, we wanted to make sure that you could get in quickly. And a theme of the book really is, you know, I had the fortune or misfortune, if you want to think about it, of being staff on the Senate Banking Committee during 2008. And a lot of the book is the lessons I took away from 2008 into things that I thought were done wrong. And to me, one of the things that was done horribly wrong in post-2008 was how difficult it was to get assistance. It was, you know, huge stacks of paper back and forth between lenders and borrowers, and took months.
But I read some of those memoirs, and at least the telling of those public officials in the moment, they were taking phone calls from New York every day. They were getting help, were they not?
Yeah,
who was having trouble getting help?
Wall Street didn't seem to have trouble getting help in 2008, but Main Street did, and so the homeowners, the renters, and so we decided, you know, that, and this is the story of the book, is how we made this quickly. So, for instance, rather than all this paperwork you had to do, you know, were you at risk of foreclosure in 2008? We made it very easy to get in. But I'm an economist by training. And so if you make it easy to get in, you certainly risk that you get people in who don't need it. And you are in the middle of a crisis. And just like on the healthcare system and the financial system, you do need to triage. You've got limited resources. How do you make sure that you're targeting those with the biggest impact? And I really walk through some of those decisions. So while we decided ultimately on the homeowner side, we would do what I call the honor system. We would let you call your mortgage servicer, the one who collects your payment and forwards it to the investor. And if you simply stated that you had lost your job or an income, a decline from COVID, we let you get in the program. Now, of course, to make sure that people didn't abuse it, we made it very clear that you were going to pay back whatever assistance you got. So, you know, there were calls at that time, of course, for mortgage forgiveness and free rent and such. Now, of course, as you sort of said, you know, I entered as a financial regulator, Fannie and Freddie, when COVID hit. Well, I guess I should roll back and say, when I walked in the door as regulator for Fannie and Freddie in April 2019, they were leveraged 1,000 to 1. So fair to say, a strong wind would have blown them over. We had gotten them down to only 150 to 1 leverage by the time COVID hit, which is still dangerously leveraged for a financial institution. Part of the relevancy here is, even had we wanted to forgive everybody's mortgage, we didn't have the resources to do that. And certainly Congress was not going that direction. So both for how do you control people taking advantage of the program, but being generous on one end, you had to make sure that it was very clear that it was going to be repaid. And we had to do that, be able to keep Fannie and Freddie afloat. Because again, my job first and foremost was the safety and soundness regulator. How do you keep the system functioning? And so, you know, compared to 2008, and I mentioned this in the book, we were able to help twice as many people, 6 times as quickly. And we did it at close to a zero cost compared to about the $30 billion that cost helping homeowners have assistance in post-2008. And obviously other parts of the response cost a lot of money, but we actually designed ours to pay for itself.
And you, I want to back up. There's some things we need to unpack there. But you did all this as, like I said, a relatively new leader of the institution when everyone was working from home.
Absolutely. And that's also part of the story of the book. So I was confirmed by the Senate in April 2019. So on the job about 11 months before we really started getting hit by COVID in March 2020 in terms of lockdowns and other responses. And so had 11 months to, essentially try to get the agency to where it needed to be. And as I do document in the book as well, the agency suffered a number of morale problems. There are questions about whether the agency would even exist in the future. So a lot of the conversation book is how we got the agency ready. And it's, perhaps interesting. It's one of these, I guess, few, what's the thing about being paranoid when people actually are out to get you? This is one of these things about me obsessed about crises, and well, one does actually come. And so when I started in the job in April 2019, I repeatedly said to the staff and said in my public comments, this has been a long housing cycle. It'll end at some point, and it'll probably end painfully. So how do we prepare for that? So we had spent a year, trying to strengthen the credit quality of the mortgage market, trying to strengthen the infrastructure of the mortgage market, not knowing what the next crisis was being, but highly certain there would be another crisis at some point.
So let's back up just for a moment and unpack this leverage. Fannie and Freddie are two institutions. They are involved in when a regular person goes to the bank to borrow money to get a home. Fannie and Freddie become involved how?
So they would buy your mortgage, and there's a very accessible conversation and description of the book about how that backroom operation of the mortgage market works. And to keep in mind, this is a $7 trillion footprint of our economy. That impacts almost everybody lives somewhere, and many people own a home. So when you go to get a loan, you would go to a lender, they would originate it. Sometimes they would keep it on their balance sheet. Sometimes they would sell it. Often they would sell it to Fannie or Freddie.
How could such an institution get so leveraged if they have financial regulators? Were people asleep at the switch?
Well,
the laws not cover this?
But the short answer is yes. I mean, so as you may recall, Fannie and Freddie failed in 2008. We're taken to conservatorship by the regulator. Conservatorship is an administrative bankruptcy. So it's essentially you're running a bankruptcy by an agency rather than a court. But the objective is the same, which is to fix the companies, bring them back to the financial house and get them out. That happened in 2008. Fannie and Freddie are unfortunately still in conservatorship today, despite the congressional mandate, for them to be fixed. So I think part of the tension was, and to be frank about it, until I'd gotten there really had not been a real view at the agency that their job was to carry out the law and fix the companies. And this is a decision. It's not a question of whether Fannie or Freddie should exist or not. Those are congressional decisions, and I certainly have strong opinions on those. But my view was, I'm taking this job. I have promised to carry out the law, and the law is we fix them and we get them ready. And of course, the fortunate thing is that is consistent with also preparing them for a crisis. So we started to build capital in 2019. And to kind of put this in perspective, when I walked in the door, Fannie and Freddie, again, between them, $6 trillion footprint, another trillion with the Federal Home Loan Banks. So between them, to back a $6 trillion footprint, they had $6 billion in capital. Again, the 1,000-to-1 leverage. And why this was so critical is that their losses during COVID were in the neighborhood of about $6 to $7 billion. So had we not started building capital in the fall of 2019, Fannie and Freddie would have failed during COVID. So I know we often kind of write the stories about the disasters that happen and the first responders and the people who come and clean up. And I thought it was so critical that somebody write a story about the disasters averted, the things we did to make sure that bad things didn't get worse or didn't happen.
So let's start with a first principle question. You're at a federal agency charged with regulating for soundness in the financial markets related to housing and mortgages. Why are these national concerns? Why you said yourself, everyone lives somewhere.
Yep.
But no one lives in all of America.
That's true.
So
I'd like to try, but
I learned to my great unhappiness from your book, we have housing programs spread across the Department of Agriculture, Department of Defense, Department of State, Department of HUD, obviously, Housing and Urban Development. all of these agencies are involved. They're all doing something or another for homeowners. Why are we doing this at the federal level of our government?
That's a great question, because certainly the biggest housing problems we have are fundamentally local. I mean, the local governments, state governments, city governments, county governments really determine what housing supply and what housing's got to get built. Most of what we do at the federal level is either subsidize the mortgage market, and the financial markets behind that, or we may provide assistance via public housing or rental assistance. But again, at the end of the day, housing affordability, despite the federal programs, there's a reason that, Oklahoma City is cheaper than San Francisco, other than the obvious demand reasons of people wanting to live in one more than the other. So we certainly have had a very convoluted problem. A lot of this is really dependent on the history. We had a very fragmented banking system. A lot of our infrastructure of our mortgage market goes back to the Great Depression. The Federal Home Loan Banks were created under President Hoover in 1932. Fannie Mae was initially created under President Roosevelt. So you had these programs that grew out of a very convoluted banking system. And you really, so much of the Great Depression focuses on 29, but we had a housing boom and bust and a mortgage boom and bust in the 20s as well. And so we really are living with an infrastructure that was built 100 years ago, 90 years ago. And certainly, I don't think it makes sense for today's infrastructure. But, one of the recommendations I have in the book is that if you're going to take over and run a federal agency, you'll save yourself a lot of bandwidth if you recognize that fixing the overall system is the prerogative of Congress and the general public, and that your job is to simply try to make a bad system work better.
One more thing I want to unpack before we move forward. You mentioned this obsession you had with crises, and part of this was born out of your experience as a legislative staff person in the early aughts and leading through the crisis, the legislative response. You're very familiar with these laws, having held a pen that put some of these words down. But there's a particular anecdote in the book that I'd like you to expound upon, if you would, and that was from prior to going to FHFA. You were working at the White House for the vice president and tasked with helping identify and staff financial regulatory agencies. And you write that one thing you wanted to screen for, and was very important, was how a person, a nominee, would handle a crisis. What did you look for to identify a person who could handle a crisis
So that's
well?
a great question. And let me start with making an observation of one of my personal pet peeves, which is, and we've heard this over the last couple of weeks as well. We heard it in 2008. We hear it every time, where regulators will come out and say, we were forced to, we needed to do this or that. That's all wrong. Choices were made. The uninsured depositors of Silicon Valley Bank they were chosen to be assisted and made whole. AIG was chosen to be rescued. Fannie Mae was chosen to be taken to conservatorship. And somewhat what I want to try to make there in the book is bring agency back to financial regulation, where this kind of like throw up your hands. This isn't to say whether the choices were right or wrong, because that's important conversation too, but it is to emphasize these are choices. Nobody is forced to bail out anybody. And we need to make sure that since we recognize those choices need to be explained. And you do need to have a question of, what is your presumption? So when we were screening financial regulators at the White House, and, I was working for Vice President Pence at the time, and he's fond of saying that he was the first member of the House of Representatives to publicly oppose the TARP bank ballot in 2008. So we took very seriously that while we wanted regulators who would be able to not immediately go to bailouts, again, maybe there are arguments where, as the lawyers would say, you have a strong presumption against a rescue. And of course, maybe that presumption is rebuttable. And you could essentially, if you feel like you need to do it, do it. But, there is I call it in the book, the rescue first, ask questions later approach, or you could also say, when in doubt, bail it out approach of so much Washington. So we wanted to make sure we had regulators that flipped that and said, I'm going to actually look at the facts first. I'm going to try to analyze the situation first. And therefore, maybe we can avoid ballots. We can look for other alternatives. And that's really part of the conclusion of the book. And, I do say I was a little disappointed, in the crisis that some people who I had been involved in getting confirmed and elected were perhaps too prone to throw public money at problems than I had led to believe. But I think at one point I say in the book, in reference to the Federal Reserve, for instance, that one conclusion I have is that the Federal Reserve changes the governors more than the governors change the Federal Reserve in terms of the appointed leadership. And I did kind of want to give people a sense of what it's like to be in those positions. And again, 99% of the phone calls you get will be people asking you to rescue them. And we know, for instance, as has been reported, several calls from Governor Newsom to the White House and others during Silicon Valley Bank. And I did want to give a sense of this is the pressure you feel. And I also, relay some of the stories at the time where, there were press accounts calling for me to be fired and run out of town because I wouldn't rescue the mortgage industry during that time. So again, a very one-sided sort of pressure where the easiest thing is to do is just to give in. And I wanted to make the argument in the book of why you shouldn't give in and why a principled approach that is based on data, based on analysis, is the preferred way to go and that it can work well. So I wanted to give the story of, here's a call for bailouts that we looked at the data and said it wasn't necessary, said no to. And despite dire warnings of the sky falling, the sky actually did not fall. And we ended up being right. So I thought it was important to tell that story so that future regulators and the public can read that and say, let's slow down a little bit before we throw public money at every time the financial markets have a hiccup.
Did you have trouble sitting in the seat, taking these phone calls, saying, help me now? Did you have trouble with the humane problem? I mean, we're talking about where people live.
Exactly. That's why we focus on homeowners. So we were, arguably in the book, very generous with homeowners and renters. Where we were stingy was with lenders.
And just to clarify, in almost every case, the lenders knew what they had signed up for. So they had contracted for the risk.
Yeah, that was the other disappointing. The number of occasions where we had, essentially bought insurance and then the insurance company didn't want to pay you is the equivalent. There's multiple instances of where we paid for services and suddenly somebody didn't want to deliver those services. So there's a little frustration there. And again, this is in the context of where the airlines are being bailed out, everybody under the sun is being bailed out. So certainly there were parts of the mortgage industry who kind of felt like, well, everybody else is going to bail out. But again, this was my part of the puzzle and how we resisted that and how we were really focused on the data and really tried to look at this and say, where were the needs? And again, we also had resolution planning. So one of the big questions today was, for instance, Silicon Valley Bank, is we were all told that Dodd-Frank would end bailouts and you'd have this orderly resolution mechanism so that if anybody failed, there wouldn't have to be bailouts and there wouldn't be a knockoff on the system. It wasn't used. Whereas we were fortunate, and again, a lot of the stress in the financial markets discussed in the book is on the mortgage servicer side. And remember, the mortgage servicer, you've got your loan, the mortgage servicer is the one you send your payment to, and they forward that payment to the investor. And if you run into trouble, or worst case, if you need to be foreclosed upon, the mortgage servicer handles all that. So there's a window of time where even if you stopped paying your mortgage, the mortgage servicer still is required under some circumstances, not all, under some circumstances to forward that payment on to the investor. So obviously there's a few months of financial stress on the mortgage servicer. Again, as you've touched upon, they were paid to take care of that. And so we wanted to make sure that that system would continue functioning. And we had actually in fall of 2019 had a servicer enter bankruptcy. So we had just only in the 4 or 5 months before COVID taken a failed servicer and transferred its servicing. So we knew how this worked. And one of the messages of the book is it's so critical in a financial crisis that you clearly project as a regulator, if X happens, we're going to do Y. And I really kind of feel like the current events have gotten muddied because, who knows which depositors and which banks are really, back today. So the argument really in the book, and I wanted this to be a counter, you kind of see this where, Greenspan was known for his constructive ambiguity, and Treasury Secretary Bob Rubin was known for.
I noticed you didn't use scare quotes.
Scare quotes, and Treasury Secretary Bob Rubin was known for his view of like maximal optionality, and so there is this view among regulators that we don't want to take it. They don't want to take any of their options off the table, but what they miss from the flip side is that if they're not willing to bind themselves to a path, then market participants and the general public don't know what they're going to do. And to this day, we still don't really know why Lehman was treated one way and Bear was the other. So an important message of the book is why it's important to be transparent and consistent in a crisis, and not to just assume as a regulator that you're better off, keeping all of your options, but also keeping the public guessing.
The academic training that you receive, there's a lot of discussion in economics, in public administration and policy studies about what's called capture.
Yeah.
What you're describing is rail regulators who are think of their constituency as railroads, or people who ship on railroads, as air traffic. The same. Was your constituency the law, or was your constituency in the financial markets? Because we've described you as a former financial regulator.
Correct. I mean, because the Federal Housing Finance Agency, FHFA, regulates Fannie, Freddie, the Federal Home Loan Banks, which are financial market participants. Now, there is a conversation of balancing these various pulling in different directions. And so certainly, you don't even really need to be deeply cynical about it. And I'm not dismissing the cases. Certainly with a lot of financial regulators, they're a revolving door where somebody leaves the regulator one day and works for the industry the next day. Those things are real. More impactful is the fact that the regulators spend 90% of their time talking to the regulated entities. So even if it's not something where it's intentional, it just becomes you end up having, sort of Stockholm syndrome, which shared set of assumptions and conversation that really influence the regulator. And this is whether it's long-term career staff or political appointees. But, partly having worked on Capitol Hill, I've long been of the view that, your first and foremost responsibility is to the statute. Congress has made deals, Congress has made trade-offs, and your job is to respect those. And I do think part of the anger and sometimes cynicism toward regulators is when they decide to treat Congress's, the laws as advisory. So, Congress decided that $250 is the limit for deposit insurance. And you really shouldn't, as a regulator, second guess that unless you've got a really, really good reason. And so part of the message of the book is to really kind of inspire, again, this deference for the executive branch to respect the decisions that Congress, has made, and to say this isn't your decision to make. And so there were a number of things where, I might have felt this way, I might have felt that way, but I recognize that this isn't my call. That call was made by somebody else. And it's a reminder that, I'm the first to complain about some of our members of Congress. But as I reminded myself pretty regularly and talk about the book,
that's a different C-SPAN show.
It is, but they were elected, I was not. And again, having that humility as a regulator of recognizing you're not an elected official.
I want to remind our audience, if you're online, there's a Q&A function at the bottom of your screen, or you can send an email to events@cei.org, and we'll try to get the question to Mark. Likewise, in the audience here, if you just signal to the back of the room, we'll make sure the microphone gets over to you and get your questions in. Mark, I took away maybe 3 big lessons that you drew. And I wanted to ask you if I got it right, and if you would add to my list. But in a crisis, and in this moment when regulation matters, I took away real stress from you on transparency, and the twin of that, or the flip side of that, is clear communication about what will happen in the future. If A happens, we will do B. I took away a lesson about targeting, means testing, creating time limits for programs, different ways to target the government programs, and independence. And you spend a lot of ink talking about the flexibility necessary to respond in a crisis. Are those the big items? Are there other big ticket items that you want people to take away?
That really covers a lot. I mean, there are conversations about, how you can deal with the troubled agency and how you can get, there are leadership lessons in government that aren't only as important in a crisis, but also important in a non-crisis environment and getting the agency there. But, the real takeaway of, in a crisis, but even in a non-crisis, it's just critical for leaders of agencies to be transparent, to communicate pretty regularly what the mission is. And also, but partly because that's how you get the career staff behind you. That's how you signal to the public as well as stakeholders in the agency's mission that this is what we're going to do. And this is how we're going to be transparent about it. And again, that I think the transparency is incredibly important because at the end of the day, market participants, everybody's got to go about their daily lives. And if you have to keep guessing what the government's going to do, how are you ever going to figure that out? So to me, I put the onus is always upon the government to, if you're going to be the rule maker, then you need to have transparent rules so people can follow and people know what they are. And again, they can be tough rules, but they need to be clear. And
it's more than, I think it's worth elaborating here. It's not just being a rule maker and saying this is inbounds, this is out of bounds. It's the rule maker for who shall benefit, where hundreds of billions of dollars are on the line.
Absolutely.
People are talking about their ability to keep a roof over their head. So these are very consequential rules.
That's why we really first and foremost focused, on the assistance programs, but how do you keep people in their homes? And so, again, I'm not a public health official. If we all go back and think about when, we were speculating whether you could get COVID from a doorknob or from the elevator, and we really a lot of questions. We didn't know the transmission. We did know that people were the vector. So we did know that if you were going to have a house under foreclosure, that sheriff's deputy did not want to go through that house, and you did not want that sheriff's deputy in that house. You didn't want to, and we did know there's a tremendous amount of research on how diseases spread via homelessness and other factors. So again, we were dealing with a lot of uncertainty. And one of the things I try to do in the book is actually be candid about what we did know, what we didn't know, where we were taking chances, where we were taking gambles, where we were making calculated risks, and even in some instances where we think we may have called it wrong. But all that said, trying to really lay bare what those decisions, are made. And so how do you keep people in their homes? And of course, you had courthouses across the country shut down in early part of COVID. So even if you wanted to continue not only the foreclosure process, but also the home buying and selling process, which of course requires deed transfers, all of that kind of shut down. So there's part of the conversation in the book about how we kept that going, how we made it so you could get an appraisal on your house if you needed to refinance, even though the appraiser didn't want to come in your house, and nor did you want them in your house. And so some of that is reminding kind of how we kept that going in the back. And even also to say, here's where we took a chance and we weren't sure how this was going to work. So I hope one of the things that comes through this is having some reflection of the uncertainty in some of the decisions that were done and some of the lessons learned.
So one of the changes that we all went through is apparent right here. We're on Zoom, right? You talk about things like appraisals and the immense amount of paperwork associated with this set of industries for the consumer and for the industry participants to provide information to regulators. How much that was set aside? Let's just talk about regulatory forbearance. How much that was set aside in the moment of crisis during these lockdowns has now crept back in versus we've been able to do away with because we learned new ways to.
And that's a great set of questions. And many of these, I either raise the questions, try to get some tentative answers and saying, there were flexibilities that were given to be able. So maybe I'll start with it really was impressed upon me and a reminder of how much of the mortgage and home buying process has historically been face-to-face. And if you think about you're buying a house, you're going to the title agent, whatever, you're closing on it, and it's you and the seller and their agent all crushed into a small conference room. Boy, that's maybe not a super spreader event, but a minor spreader event. And so again, remind you that so much of this is face-to-face. And so we looked at things that we needed to do where, for instance, we gave flexibilities where someone could drive by the house, and do a drive-by appraisal. But we also knew that was riskier. It was much less likely you were going to get an accurate. So one of the other themes of the book is we would give a flexibility here, but we would tighten here to offset the additional risk of that, and making sure what we were going to do. And even though we had a massive housing boom as people moved out of some areas, particularly trying to move to areas of the country where the schools were open and such, we saw a lot of this remote work. We were certainly concerned at that time, which is why, even though you had this big refinance boom and home buying boom in 2020, 2021, we were actually tightening standards, which I can tell you, not everybody in the mortgage industry loved that, but we were looking at this and saying, how do we kind of pull back and make sure that if we're going to get people into homes in this environment, when the prices were likely to come back to earth someday, that we can get them in a sustainable situation. So having that sustainability, there were certainly things, like I said earlier, on the mortgage assistance programs where we set up the honor system, whether that should be the path going forward, whether we should do it differently in a different environment. Of course, we set up rental programs where, we gave forbearance to the landlord, and the landlord would agree to not evict you. The whole CDC eviction moratorium was a separate issue that we were not involved in, but I do give my views on that. And again, how do we come up with things to help keep people in the home in that regard? So I think some of this will absolutely stay. There will certainly be
some of the regulatory forbearance you think we can count on.
Exactly. So for instance, one of the bigger changes, and this was probably about a third of the states pre-COVID, you could kind of have the deed transfer remotely notarized. And this was mostly places like Alaska, where, good luck getting a lawyer or a notary to come out to your home on a regular basis. So a lot of parts of the country where you've got very vast rural areas, there are already some flexibilities, because again, it's not like you couldn't be in the room, but it's more like that person's a two-day boat ride from, wherever. So, some of that stuff, other states changed. Some of the stuff we changed, some of the stuff we did change, in my opinion, need to change back. So again, it really was a sense of, how do we have flexibilities? And of course, part of the big question is, you can on one margin take additional risk if you've offset it elsewhere. But unfortunately, the long history in the mortgage market from the government is we keep, loosening on one side, and then maybe there's some safeguards, but these safeguards erode. So again, there is a worry over a time in my mind that things that we chose to do and had to do to keep the market going, housing market going during COVID, may or may not be appropriate for the long run. And again, part of the conversation of the book is maybe we should stop, as the public and question these, like, should this be the norm? Should this not be the norm? What are the pros and cons of this, rather than just keep this going?
So we've used just now, in context of the regulation and the obligations to get a deal done, forbearance, regulatory forbearance. A central decision, and it's a theme throughout, is the distinction between forgiveness and forbearance. Can you talk a little bit about that and contrast it with where we were in 2008 versus how you approach the question?
So in terms of homeowners and renters, for that matter, so to go back to that, we at FHFA were in our financial regulators. And so it's not a grant making agency. It's not FEMA. It's not HUD. And so the authorities are not there to simply say, well, you don't have to pay your mortgage. But what we could do, so forgiveness of just saying your mortgage, missed payments is forgiven, that wasn't even an option for us financially. It wasn't an option for us legally. It wasn't an option for us financially. And quite frankly, it wouldn't be needed anyhow, because we are able, for most, and again, it's important to keep in mind, about 90% of the households who ever entered into a Fannie Freddie forbearance agreement are out of it and back on their feet. So it really was this tension of, again, a good analogy today is the student loan, forgiveness that's being done under COVID, where someone may not have made a student loan payment in years. Well, if you're back to work and you're back on your feet, what's the rationale? So we did try to do this in a very targeted way, where it was, let's assist those who need it. Let's target the assistance to what the problem is. And so it wasn't taken as this is going to be a giveaway or this is going to be a gift. It was really going to be, how do we target it to the immediate problem at hand to get through that and not turn it into, another Washington expensive giveaway that has no basis to the underlying program. So I do believe at a fundamental level, whether it's a student loan or whether it's a mortgage or whether it's a credit card, if you borrow money, you pay it back. If you can't pay it back, then your lender can work with you. And part of the themes of the book is we really ran these programs in the same way a business would have run them. And the fact that lenders who didn't have to use these programs, as mentioned earlier, you get a mortgage, it might be bought by Fannie and Freddie, but a lender may hold it on their balance sheet. It may be put in a private label security. And so the fact that the part of the market that didn't have to do what we were doing, mimicked what we were doing, I think is a pretty good indicator that we were actually running this in a fairly responsible, business-like manner, and not as a giveaway of any sort, but really as a targeted assistance that was both helpful to the homeowner and helpful to Fannie and Freddie, because we couldn't withstand those losses. I mean, Fannie and Freddie were not going to be able to foreclose and take millions of homes in 2020. So that was an unreasonable, outcome anyhow. So that was never on the table, but we needed to think about doing this in a way where, again, the assistance was, as Larry Summers would say, timely, targeted, and temporary.
As he did say often.
Yes.
Let's talk Turkey for a second. I want to hear a firsthand account about the underbelly of the imperial city here, Washington, D.C. We've mentioned you've worked at the White House, you've worked on Capitol Hill in very senior positions. You've served as a regulator. I checked the text this morning, and the First Amendment still protects against Congress creating a law that somehow interferes with people assembling peaceably and seeking redress of grievances. Yep. What did you learn during this whole episode that you write about lobbying and how lobbying works?
It's a great question. And like you, I might have some disagreements with some individual lobbyists, but I'm an ardent believer in the right of people to be able to lobby grievances for their government. And I will defend that.
Were lobbyists always truthful with you?
Well, is anybody ever really always truthful with you in these circumstances? Of course not. But, but this is where I flip the script a little bit and say, it's the onus on public officials. Like you, have a responsibility to meet with outside parties, whether it's lobbyists, whether it's advocates, whether it's citizens. And sure, you understand that anybody you're going to meet with has an agenda almost always. Mm-hmm. The way I would describe it sometimes, I think in the book is, and I said this when I worked on the banking committee, if you're meeting with some Wall Street lobbyists, half of what they're saying is really important, critical that you need to hear. The other half is completely self-serving, but your job is to figure out which half is which. And that is your job. You can't go in and say, oh, well, they didn't tell me everything I needed to know. No, it's on you to ask the right questions. It would be great if everybody just was, lobbyists who came in and solely told you purely the truth and didn't have any interest. And I would go as far to say, the lobbyists I've always respected the most are the ones who were transparent about, here's my interests. Here's what my members are, here's what we're representing, here's the landscape we see. But, one of the lessons in the book, and I'm a big believer in that, the most important element of leadership in these positions is humility and recognizing that in any situation, 90% of what's going on, you're not seeing. And so you need to seek outside sources of information, but you can't rely on any one. So just as you have to, as a regulator, engage with, speak in front of, meet with the trade associations representing the industry, but you also have to recognize they're here in the Beltway too. So they've got a certain bubble they live in, like we all do. And so you do need to talk to people in the industry directly.
So you write about these phone calls that you made. You had your own kind of phone tree where you would pick up the phone and call the CEO and say, tell me about the soundness of your
So that's a great company. So, again, a big part of the book is the push and pull over whether we should rescue mortgage servicers. And
so you're a big believer in empirical work and data. How did you separate the anecdote of the phone call where a CEO says, we're doing okay, it's rough, but we're going to be fine, with the whole industry?
So you have to look at all those data points. And so, for instance, at the time of March 2020, Fannie and Freddie did business with 346 non-bank mortgage servicers. Now, as the regulator, because Fannie and Freddie have contractual relationships with these businesses, we had income statements and balance sheets for all of these entities. But obviously, accounting data is stale the moment you report it. Mm-hmm. So what we would immediately do is, and again, the mortgage industry, like many industries, has some degree of concentration. So we would get on the phone with the largest 2030 immediately in March 2020 and say, I'm looking at your most recent financial submissions. What's changed for you? This is what you told me your liquidity was 2 weeks ago. What is it today? And every morning I would get a list of, high risk servicers, the ones that we knew were riding the line. And an important story of the book. So I often kind of say the lesson of Lehman Brothers, my lesson, which I think is admittedly a bit counter-conventional wisdom, is that if you lead an entity to believe it'll be rescued, it will reject offers to be assisted. And for instance, we know leading up into 2008 that Lehman Brothers had 3 separate offers to be bought. And each time it said, no, we won't take anything less than what Bear Stearns got. So you created this expectation of assistance, and it made the crisis worse. So I'm happy to say, and I don't name names in here, but anybody who wants to Google a little bit can figure out who I'm talking about in the book. There were 2 large servicers who had private equity parents that had literally pulled billions of dollars out of these entities in 2019. And again, I have nothing against investors taking returns on their investment. But if you come after you've taken that return and take money out, then you come to Washington and say, oh, we'd like the government to put money in, then I'm going to be a little more skeptical. And so these were instances where we told these entities, if you fail, we will shut you down and transfer the value of your assets to somebody else. And so if you would like to keep the value of those platforms going, you may want to consider putting money back in. And you know what happened? They put the money back in. And those entities are around today and survived without having the taxpayer put money in. And some of this is you have to project your willingness to say, we know how to shut you down if you fail, and we're going to shut you down without public money, and we're going to do it. And if you want to avoid that, put your own money back in.
And this is a direct link to what we're looking at in the last month.
Yeah, absolutely.
There are processes available for shutting down these companies. And as long as you credibly promise that you will follow through, you get better behavior.
I know it sounds a little hokey, but it's like, say what you're going to do and do what you say. And then you actually is an effective way to govern. It's a shocker nowadays.
Reminder, before we come to the top of the hour, the online audience, if you'd like to participate with Mark, you can certainly buy the book. That's one way to participate with him. But you can send a question by using the Q&A function at the bottom of the screen, and it'll show up here for us. I'd like you to just pick up with current events for a moment. Interest rates. How should we understand what's happening with financial markets?
Well, certainly in the banking sector, I mean, and every time we have had in history these kind of interest rate changes, this is really a driver in the savings and loan crisis, for instance, was you saw these big changes under then Fed Chairman Volcker, where rates went up quite quickly, not as quickly as they did this time. I mean, it's in fairness to say the rate increases we've seen under Jay Powell have been unprecedented in their speed. And because financial institutions hold long,
but not in magnitude,
necessarily,
right.
But because financial institutions hold long dated assets like mortgages or mortgage-backed securities or treasuries, those assets are highly sensitive to interest rate changes. And so, again, many institutions hedge that risk. Many institutions may sell off that risk. But it was almost certain, in my view, that to see this change in interest rate environment, you were going to see something break. And I think it's an open question. I certainly raised some of these issues when I was still in government with other regulators. I expressed concerns about the concentration of mortgage-backed securities at banks, and said, listen, this is going to turn at some point. So it is a bit frustrating to suddenly see some officials say, well, who knew? Well, you should have known. And again, many of these things, were obvious. Of course, I want to very clearly state, first and foremost, responsibility for any bank failure rests with bank management. Even if you operate in an insane, contradictory, destructive regulatory environment, you've chosen to run a business in that environment. And if others can run it successfully, so can you. But that said, Certainly the regulators were, in my opinion, asleep at the wheel. Really kind of missed some of this. I do think we know more and more that some of the frontline regulators did see it. And again, a theme of the book is, how do you make sure as an organization that the information that the frontline employees see gets to the top? And I wouldn't say that so far for what we've seen from Silicon Valley Bank, it's not the suggestion necessarily that the Fed examiners were missing things. They were seeing it. It's the question of, why didn't it get to the top of the San Francisco Fed? Why didn't it get to the board? Why weren't these things, raised and acted upon? And again, there is a difficulty of how you can get that information to the top of an organization. And so admittedly, it's a little uncomfortable for me as an economist to talk about culture, but I really walked away from the experience running FHFA believing that the organizational culture at the regulator and the organizational culture at the entities such as Fannie and Freddie or Silicon Valley Bank is critical. So getting that corporate culture right makes a big difference, but you have to have the rules be transparent and people know how it needs to be acted upon.
So we have a institution, and I want to follow up on this culture point. We have an institution that might not be widely understood or widely known. It goes by the acronym FSOC.
Yes.
So this
Financial Stability Oversight Council.
This is like a super team, the dream team of regulators, if you will, for banking, finance related activity that came out of Dodd-Frank. You discuss different personalities and conversations that were taking place, members of the FSOC. What is the FSOC? And most importantly, does its culture maintain through time, or is it really dependent on the administration?
So the Financial Stability Oversight Council is created by Dodd-Frank, and essentially it's chaired by the Treasury Secretary and the heads of the independent financial regulators like the OCC, the FHFA, SEC, all sit on it. On a day-to-day basis, the Treasury and the Federal Reserve have a tremendous amount of influence. So even though it's in theory a council of equals and everybody gets the vote, there certainly is a tremendous amount of day-to-day sway from Treasury and the Fed. I mean, they have an outsized, the vote counts a little bit more than everybody else's to some degree. And of course, Treasury is the chair, so they set the agenda and the convener. Mm-hmm. So there is a degree to which whoever is chairing it does matter and does have an influence. It also kind of matters how cordial you were. Because I was involved often in the selection of some of the other members of FSOC, I at least started with the familiarity of many of the players. And so had a pretty good relationship with people, which is why we had a very cooperative process in 2020, where we started a designation process to determine whether Fannie and Freddie themselves were systemic. And again, we did it very cooperatively with the Fed and Treasury and identified a number of problems in the mortgage market.
And just unpack for everyone, to determine if Fannie and Freddie were systemic. What is that? That has a legal definition.
Yeah, sure.
What does that mean?
It means whether these institutions represent not just a risk kind of to themselves, but whether they represent a risk to the financial system.
Thank you.
And and if you are designated systemic, what it ultimately means is you have some backup regulation by the Federal Reserve of the entities in question. But certainly, there's the Treasury sets a lot of the agenda. And if you want to focus on financial regulation, that will be part of the agenda. If you feel like the focus is on other issues beyond financial regulation, that can take up the agenda. Part of the frustration, of course, is that, I kind of quip in the book that FSOC is really good at identifying problems that none of its members have actual responsibility for. And it's not so good at, there is a reluctance to criticize your fellow council members?
Well, let's press on that for a moment. I understand collegiality and different levels of expertise on different questions, different underlying statutes that drive the activity of these different agencies. But you've used a word throughout the hour that I think is really important that we tackle before we finish, and that's independence. Yeah. And if they're truly independent, does it matter what one member of a dream team of regulators says about them? I mean, the OCC and the FHFA and the CFPB, these folks are independent from political pressures, right? Is that what it's about? To
a degree, because no degree of independence is pure. So certainly you should say, if the Treasury Secretary doesn't want it on the agenda, it doesn't get on the agenda. So, I mean, to be slightly cynical about it, my view is that Dodd-Frank created FSOC to give the Treasury Department more influence over the rest of the financial regulators. That's what it means on a day-to-day basis. Mm-hmm. And I would say the success or failure of FSOC in any one day of the week depends on the Treasury Secretary. You can try to put things on the agenda as if you're a member other than Treasury or the Fed, and you will generally have a hard time doing it. Not impossible, but again, ultimately, what gets debated, what gets decided, is really first driven by Treasury and second driven by the Fed. And again, that really is kind of the process in a big way. Certainly, as you may know, in the book talks about the Supreme Court ruled on the independence of the agency I headed, FHFA, and we lost a degree of that independence, which I think is unfortunate. And I talk about that in the book a little bit. But, it also allowed us to move quickly. So, for instance, I talk in the book about here are decisions we were making that, okay, we would make a decision and let the White House know. And I was at the White House. I know you got to clear things, OMB, you got to process. It's not always designed to move quickly. But because we were independent, we could kind of force that process to move a little quickly by saying, well, we're going to announce this on Tuesday. If you're ready to go with us, great. If you're not, we're going to go ahead. And so your willingness to kind of nudge people along as an independent regulator, but also to kind of keep yourself divorced from the day-to-day. And I mean that in a way where you're divorced from day-to-day political decisions. So at no time, and we had a great collaboration at FHFA with HUD, with the White House, with Treasury, with the Fed, and I detail some of those conversations and interactions in the book. But at the end of the day, we had a fair amount of flexibility to go our own way.
So I'm going to be a cynic for just a moment. I don't live that way. I don't wake up as a cynic every day. But to say that you had a measure of independence from the politics, the day-to-day political decisions, I think is the phrase you used. That suggests the non-independent agencies are not, so that somebody over at Ag, somebody at Treasury is taking calls from a senator who's taking calls from the president of the biggest bank in that state, and they are making decisions that are not adhering to the law. They're making political decisions. Is that what I'm hearing?
I think you have to think of it on a continuum, because certainly as somebody who spent 2 years at the White House, your biggest frustration at the White House is that the agencies are going their own way and ignoring the overall vision and coordination of the administration, and may actually be working in conflict, are likely to be unduly influenced by the constituency groups of the agency. So that's kind of the White House of like, boy, none of them are really, acting as if they're on the White House team, the administration team. So there is that tension back and forth. But the White House itself obviously is subject to pressure from constituencies. Like I said, in the Silicon Valley Bank case, we know that Governor Newsom called repeatedly to the White House, and believe I also called Treasury. So people may try, different avenues to try to influence agencies. If you are a quasi-independent agency like the Federal Reserve, you have, a fair amount of influence, although if you're the Federal Reserve and you send your alumni to Treasury in the White House, I quip at one point, maybe we need to make sure there's independence of the rest of the government from the Federal Reserve in that regard, rather than the other way around. But all that said, having that kind of independence, but you also have people who have, worked together for a very, very long time, and that's got pros and cons. I mean, much of the existing team, whether it's Brainerd or Yellen or Powell, have worked together, or Grunberg at the FDIC, have worked together for years. We're all mostly architects of Dodd-Frank, so they own the status quo to a degree, but having those working relationships, ironically enough, in some sense, I think I was able to maintain a fair degree of independence from the administration of the White House because I had worked in it and they knew me. And so there was a trust in, well, Mark's going to do this, and we understand that.
The simple question,
sure.
And I do want to get to one other topic in the last 2 or 3 minutes here, but a simple question: if the White House, popularly elected president, charged with administering being the executive of our federal government, if the White House views these different agencies as not on the team, what branch of government are they in?
That's a great question. And so, and it is I mean, it's your principal agent problem that we all learn about.
Well, that's different than the question.
Oh, there is a degree to which. So some of it, as I mentioned earlier, financial regulators set aside the kind of revolving door style capture that is real and we worry about, but just the everyday who you interact with. If you're at the U.S. Department of Agriculture, your time is spent talking to farmers. And I grew up on a farm. I love farmers, but they have a financial interest like everybody else. If you're at HUD, you spend all your time talking to the housing industry. Any of these agencies, I mean, even like think about the purest of public missions defense. I mean, I think it's fair to say that if you spend all your time talking to the defense contractors, that's going to influence what you think the right approach is on anything. So part of the job at any White House is trying to get the agencies to reorient to what are the bigger picture when, again, it's not a malicious thing necessarily, but the information they receive on a day-to-day basis is not, pure, is not now non-self-serving. And you buy into and you're, reinforced with the assumptions that go around that policy issue.
Okay.
And that's very difficult for an agency to break out of. And again, I try to give some advice and thoughts in the book how to, not only be kind of independent, how do you follow along? How do you be independent of mind?
In just a moment, I'm going to ask you for a summary statement. The one thing or the two things that we didn't get to cover that you think is most important. But beforehand, I do have a self-serving question. And I want you, if you would, to share with our audience the Mark Calabria vote on the greatest jam band of all time. I've heard different arguments, and you say what?
I'll just provide the context that one of the things I tried to achieve in this book was to bring to bear anecdotes of day-to-day living during COVID.
Mm-hmm.
So, mention my cats on occasion, mention music I might be listening to that when Chairman Powell calls.
And again, I'm going to press you. I haven't heard an answer yet.
That's fine. So, because you raised this because there's a reference to as one of the weekend, fire drills in March 2020 is evolving. I start that day listening to a little Grateful Dead on my radio. So again, just kind of the things we were all kind of putting up with and the importance of music and pets and family and all the sorts of other things that you're trying to deal with during this pandemic. Hopefully when people, read those and think about that, they'll relate to that. And then in the future, historians will maybe put that in the context of what it was like to be, I actually think this is a point that really deserves far more digging into, which is I make the observation in the book that in 2008, you essentially, had all of these people stuffed into conference rooms at Treasury and the Fed and these hour-long meetings where everybody's, yelling at each other, reinforcing groupthink and panic. Whereas the response in COVID was one 10, 15-minute call after another by yourself. And so, there was never a moment in March 2020. I might have over the course of the day spoke to Mnuchin for an hour or two, but it was never at once an hour or two. It was like, okay, thank you. I'm going to get back to that. So it really was a very different environment. And quite frankly, I think it was an environment that probably lent itself less to groupthink than what you saw in 2008. And so it certainly is an interest of mine. How do you set up decision-making structures to reduce groupthink? So there is a risk. And I do think that part of the outcomes we had in 2008 were because the psychology of how the decisions were made. So I delve a little bit into that in the book as well.
So what I hear here is that regulators are people too. They deal with pressures of family and pets and home, and it's helpful that they have regular lives so that they can deal with the people that they're regulating, and that more than Dave Matthews, widespread panic, fish, that you're a dead guy.
And I try to convey some of that in the book.
All right.
The personality of it and living through some of that in the book.
Last word before we wrap up, and I want to give special thanks to our audience with C-SPAN, with online, who will be watching this via YouTube. Mark, what's the last word for the day?
Well, I think the last word for the day is to remember that decisions made in a crisis truly are choices and decisions, and public officials owe the public an explanation of why they made certain choices and owe the public that transparency. So I just want to leave with, you don't have to abandon principle in a crisis. In fact, it's the opposite.
Thank you very much. The book is Shelter from the Storm. It's out this month from the Cato Institute, and I appreciate all of you being with us.
Thank you so
I'm Kent
much.
Lassman, and we'll be back with more programs, including book forums at cei.org.